right, up next, like I said, we have Serge Berger here of the Steady Trader. This is Kyle Bazzi filling in for Joel L. Conan, who's in Jamaica for the week before the holidays. We got 8 minutes to the open. Good morning, Serge.
Good morning, sir. How are you?
I'm doing fantastic, man. How's the weekend?
Not bad, not bad. I'm still here in sunny Florida. It's all good. Not quite Jamaica, but
Not quite Jamaica, but
it's nice.
it'll beat Detroit here, where Benzinga's headquartered at.
Yes.
We got a interesting couple weeks coming up here going into the new year. You sent over a couple charts you want to take a look at. I have the first one up here, the SPY versus the OIH Market Vectors Oil Services ETF. What were you seeing here?
Yeah, so basically what's going on is you continue to see obviously oil under pressure. This morning we see a little bit of a bounce, and that could lead to a bit of a snapper. But basically, in the bigger scheme of things, what this chart does very cleanly is just kind of show you the S&P in blue versus the OIH, which is the Oil Services ETF. And you can see a massive, massive divergence. Now, it's important to understand that this doesn't really necessarily mean that we're going to see, a huge rally in oil service stocks or a massive collapse in the S&P. But it basically means through a multi-week, multi-month lens, there'll be some sort of mean reversion, right? So it basically means that the large caps are overbought still, so some of these oil service stocks are just way, way oversold on a relative basis. And I think it's important to keep that in mind as we head into year end. There may be a Santa Claus rally. Who knows, right? But I think this is a pretty key to understand, because a lot of people are getting very bearish on some of this oil stuff, and they're still kind of bullish on stocks. And it kind of should be the other way around.
Interesting. We were just talking about that where, oil and the stock market started to kind of move in step here. When oil made a move, the stock market would follow. What's that bearing any weight on you?
Yeah, so that's obviously what happened. Again, it's all about time frames and all about duration. So if you think about the stock market in sort of a multi time frame way, you need to understand that it takes time for certain things to take place. So for example, oil stocks, what that has finally caused is the S&P to come down, but it doesn't happen overnight. So the inverse correlation will at some point resume between oil and stocks through the longer term. But I think in the immediate term, there's a very close relationship. So if you want to just actively trade this thing, the broader market, just all you got to do is look at oil and oil stocks. And if they can catch a bid, we'll be fine for a bounce maybe into year end.
Now, so looking at this chart, and obviously here in red we have oil, and then here in blue we have the SPY. So OIH here as what is it,
It's an ETF. It's oil services stocks. You got guys like Schlumberger and Halliburton and things like that in there.
great. Now, are you looking at this and as a trader saying, okay, we got some mean reversion, buy here OIH and short the SPY?
Um, yes and no. I think that's more like a sort of like a hedge fund type of play if you want to put this on. But yeah, I mean, personally, in full disclosure, the way we're positioned right now is we are a little bit long some of the OIH kind of things and short S&P on a tactical basis. So it's not an immediate term trade to really come to fruition. But I think being tactically short the S&P 500 here, going through the year end and into the first quarter of next year, will probably pay off. So being long oil stocks is probably more of a short-term play, if that makes sense.
Interesting. And then, do you have anything you're looking at specifically? We're talking about the oil sector, and I've been
Mm.
doing a ton of research on this, trying to figure out, hey, where would you want to play this? And I read everything from value plays to our charting and short-term swing trading plays. Are you looking at overall ETFs? Is there specific types of ETFs like the OIH, since it's just services, that would be the best plays here while oil continues to get pummeled?
Yeah, so exactly. I think that's you kind of put my rant in a better context. So basically, the OIH, I think, in a near term has a sort of a good bounceability probability, right? So in other words, when we're looking at oil stocks right now, I think from a risk reward perspective, you probably can be better off looking at the large oil services stocks. So the OIH represents that quite well. You can play some of the smaller guys. The problem with the smaller guys is they really have structural issues now because of the high yield debt that is particularly in the shale production kind of stuff. Those guys they have structural issues. Halliburton and Schlumberger, are they really going to have big major structural issues? Probably not. Right? They may have to reprice and find new range because literally they've used the wrong oil price as an input price in the model
Mm-hmm.
for 12 months now. But in the grand picture, that's not going to be an issue. So I think conservatively, you're probably better playing the OIH and alongside once we have a confirmed bottom for a bounce. And I think all you need to see is some sort of bullish reversal on a 1 day basis, and then you probably get a bounce for a little bit.
All right, let's pull up the next one here we have that you wanted to take a look at, and that is USO. That is up on the chart right now. What are you seeing in USO, and what did this chart show?
So this is the USO. It's basically the United States Oil Fund. It's basically oil, right? So for the lack of a better term, but it's basically the price of oil in one of them is red and the other one's blue. It doesn't really matter, but the other one's high yield. Okay, and it kind of goes to the point that I just mentioned, which is to say that a lot of the oil services companies, the smaller ones, particularly in the shale business, they have a lot of high yield debt outstanding. So this tells you that those stocks are probably going to have probably bigger structural issues. On the other hand, it also tells you that high yield can actually be a pretty good forecasting tool for stocks, for the broader stock market, because high yield's been plummeting all along, while the broader stock market, like the large caps, the S&P, which is kind of artificially inflated, kind of held up there. But at some point, the bond market's a truer read.
Now, I'm very interested in a couple of things. So I read a really good report talking about if oil stayed at the 60 to 65 range right now over the next year or 8 months or whatever, what companies could actually sustain with the actual cost structures like you were referencing. When we're talking about technical analysis, that doesn't play in when we're looking at the chart. Does that concern you at all when looking at oil stocks?
Yes, of course, and again, I think there, again, it's a matter of time frames, right? So if you're talking about the shorter term stuff, like, are we looking for a bounce here for the next few days, maybe a couple of weeks, and in some of these really oversold oil stocks, you can probably buy anything because the correlation can be very high. The problem is going to be in the longer run, right? Or is there going to be a credit event in the high yield space? That'll be a real issue, because you have all these credit derivatives that are tying all this stuff together in a beautiful knot. If that knot unravels, we got a real issue, right? So I think here too, it's the same thing. You can play anything on a bounce here near term, but afterwards, it's probably going to be better sticking on with the larger guys who actually have a capital structure that they can tie together.
Interesting. Yeah, that is very true. And it's just a crazy time right now. I mean, obviously, I also read another report talking about just the amount of hedge funds that have blown up because of this, monumental move downward in oil, and not even they expected it, which we consider the smart money. When do we see a move in here? And obviously, you pulling out your crystal ball here. Do you have any indication of where you think oil will go? Starting into the new year.
I think the issue here is that it's indicative of an economic slowdown, and in addition, of course, it's a supply and demand issue, right? So you sort of have a double whammy. And then you have the issue that there's just the inflation expectations in general all year long have been too high, and so the bond markets, it's starting to finally give people what they didn't want to see, which is lower inflation. So how does that tie into oil? I don't see oil having a massive rally, but of course I think in January is the next OPEC meeting. So it's kind of a standoff right now. The Arabs are basically seeing if they can push the some of the U.S. guys out of business and vice versa. I think it's a dangerous territory to make any major stands right now.
Interesting. Yeah, it definitely is, and OPEC is going to be playing an interesting part into the overall story. Let's look a little more broad market here. Pulling up the ES. Anything on your watch list that you can share with us on some stocks you're looking at?
Yeah, I think it's a tale of two tapes. And again, as long as we keep things in context, keeping those two charts that I just showed you in context, I think we can make some nice trades. So December technically, generally, is actually a very good month for trading. I usually have one of my best months in the month of December, and it's because you tend to have a very somewhat defined range with limited volatility. Of course, it's been the exact opposite so far this year, but the back half of December tends to be more that kind of thing. So I'm looking at things like Facebook. Okay, I'm long Facebook. Full disclosure, I think $80. Just so it's going to fill that gap from the previous earnings. Down gap from October. That looks nice to me. I'm looking at things like BIIB, Biogen. A lot of those stocks are really, really giddy to break higher last week. Didn't do it, but I would say they have a very good chance of doing this now. So BIIB is a good one. I still like things like, which I think what was the other one there? Cheesecake Factory is a beauty.
What's that
You
ticker?
know, cake, CAKE. So there's a lot of stocks like that are setting up that still want to give us one last good bounce, but they haven't been able to do it for the past couple of weeks because the broader market has kind of come under pressure, particularly last week. So there's stuff to play in alongside, but I really do think structurally, you're tactically, you got to still be short the broader market, probably into the first quarter of next year.
I mean, your steady trader portfolio at the steadytrader.com is having a fantastic year. And you've really done a lot for your subscribers. Talk about when we look at Cake, we look at Biogen. What are you looking for specifically? Obviously, you are a candlestick expert and guru, but what are you looking for both to the long side and short side of a stock with the candles?
hmm Yeah, so I mean, the candlestick to me is more the risk management tool, right? So I think you have to look at more than just a candlestick chart to be able to do a trade that's more than 5 minutes long. But basically, you want to see something that has a lot of support, underneath it. So if you look at, for example, the Cheesecake Factory, it had some very nice bullish support of bullish reversals, particularly on December 9th when it bounced off the 50-day, which for this stock actually is a fairly useful moving average. So you want to see kind of good support that visually kind of curls a stock up against resistance, and Cake does that beautiful here, pushing it against that $49.20 area. So that's actually a pretty good thing. The longer a stock remains or curls up below resistance, the more powerful its ultimate breakout, if there is a breakout. So, I think, the winds are back here into year end usually. So looking at a stock like this that's kind of curling up has a pretty good probability of seeing some sort of pop into year end.
Now, we were just talking about earlier with our first guest, Anne Marie, about IBM and what happened with the move on
Mm.
Friday. Let's get your perspective on something like IBM. She was looking at, and I'm going to pull up here the last few days, the chart where it was just, resisting at 160 and, had a lot of support. I'm sorry. And then dropped down 5 points to 155 and ticking
Mm.
around 155.62 right now. How are you looking at a stock like this?
Yeah. So IBM is I flagged IBM. I think it's IBM at some point back in October after that fall, and I said, listen, it's very simple. To me, this is a risk of war play. So you look at this and you see that the stock is basically just after stock drops in a big way, it can do basically one of three things. Two or three have a higher probability. So it can fall like it can start consolidate like this stock did in a very tight in a very tight fashion. And at that point, there's really nothing to do until the stock actually drops or rallies in one way or another. And it did so on Friday, right? So from here on, you basically have a stock that continues to look heavy. There's no support. No one was there to buy it. So you probably have room down to the 150 area. The issue with something like an IBM is that obviously it's in the Dow, and a lot of people have asset allocation tools. So you want to be really careful with something like that going into January. Actually, you know what? IBM, I'm not even sure if it's in the Dow anymore, but it doesn't matter. The point is, it's a big major company, so there may be an issue into January. So I'm always a little bit weary shorting a big stock like that, particularly if it's in the Dow
And you're
into
talking about
January.
by asset allocation, you mean the funds that need to rebalance by the end of the year, or either take
Well,
profits
yeah,
or.
or just put capital to work in the new year. So if you look at historically, the stock market tends to have a pretty good balance the first week or two. Sometimes it's even just a day or so in January, and then it ends up kind of selling off a little bit. So that I think IBM would be a pretty good candidate for one of those things where people just kind of have to put some money into.
And the other chart we had up too, and talking about bonds, TLT, which is I know you have traded in, which obviously just had a crazy year. Any thoughts on TLT?
Yep, we've done really well with TLT. I continue to think that inflation expectations are just too high. If you look at the economic growth numbers, I think that's a fairly straightforward call to make. It seems to be something that very few people believe in. So we've been long bonds more or less all year, a little bit so, here and there. And last week we made another 2-3%, which on for a long-term bond ETF like that's actually a lot of money. It's like a really good
Mm-hmm.
return.
Mm-hmm.
At this point, I would think it's a little bit stretched. So if we do get, you get back to that inverse relationship. So if we see some sort of bounce into year end in the S&P, I would suspect that bonds will probably pull back a little bit. But I would love to buy these things again, which kind of brings in two major points. Um, there are two. If I talk to institutional investors, and I do on a daily basis, there are two things that people are not positioned for. A, it's a continuous drop in large cap stocks, so the S&P 500 into year end. Okay,
Hmm.
and if you consider the massive V-shaped reversal we've seen off the October lows, there is an argument to be made that that's it. There's no Santa Claus. We're done. We maybe chop back forth a little bit, but at the end of the day, we'll probably be a little bit lower than higher into year end. Not a lot of people are positioned for that. And the second thing would be the opposite. You could see a surprise play by small cap stocks, the Russell 2000, outperforming both on a relative and absolute terms the S&P 500. Not a lot of people are positioned for that either. So these are not my base cases, but they're two very crucial things to watch for, because if we see those moves, they could be very sharp.
All right, I love the overall outlook on something, and then getting into the trenches with the technicals and the candlesticks to figure out your entry and exit points. It seems to have done great for you this year. And anyone that's looking to learn how to trade candlesticks, interested in furthering their skills and putting another tool in their tool belt, definitely check out Serge with the Steady Trader at thesteadytrader.com. Serge, thanks a lot for coming on today, dude. Enjoy the rest of the week and good luck trading today.
Thank you, sir. Take care.